Awesome. Um, Thanks so much, everyone, from joining. Welcome, welcome. I am Michael John Mayette. I am the Chief States Officer for First Children's Finance. I work with all five of our state offices across the country. And specifically, I'm the interim state director for our Michigan State office and proudly here kicking us off today representing our Michigan-based team, which I'll introduce in just a second. Before we go too much further, I just want to do a couple of pieces of housekeeping, letting folks know that we are recording this and it will be recorded and posted to our website and social media platforms later. So just if you are able to stay on mute for most of the time, please, we have a smaller group, so please feel free to come off of mute and ask any questions, raise any thoughts or reflections that occur to you throughout. We will make sure we have time for discussion at the end, but also it's a smaller group, so happy for this to be much more interactive. The chat is also a good place to drop any Q&A or discussion as we go along. We are going to focus today on our business of childcare, on the state of business, on the state of childcare business survey that we conducted. And that's really going to be the focus of our conversation today. But we'll also share at the end some other ways that you can stay connected and partner with First Children's Finance. And we're happy to talk about that a little bit at the end as well. So let me just share a little bit about what we're going to do today. We're going to really talk about the current state of childcare business in Michigan and specifically in Detroit. So this year in April, we released a survey. We'll talk through the numbers. We received about 10% of childcare providers across the state of Michigan, and about 4 or 5% of those in Detroit responded to the survey. And we really wanted to hear directly from providers about how the current economic conditions, workforce issues, public funding are affecting the childcare sector. As an organization, we really try to be responsive to the changing needs of childcare business owners and entrepreneurs. And there's been a lot of change in the last year. So we really hope to use the data collected for two purposes. One, to ensure that we are offering the best possible programs and services that we can to those that we work with. And then we also want to share with partners like you all so that you can also benefit from that information in terms of the folks that you work with. So the purpose of today is both to share with partners, but also to share back directly the information that we collected from the childcare businesses themselves. We know that anytime we collect data, we want to make that data available to those from whom we ask the data. And we really want to start off this presentation with a great thank you to all who contributed to the survey, both in terms of getting the word out about the survey, but specifically those who completed the survey itself. This is really valuable information that will inform our work and hopefully the work of others. And we're really grateful for those that participated and responded. We go to the next slide and just do a little bit of background on First Children's Finance, and we'll start with the most important part, which is our Michigan team. You'll be hearing from Jessica in just a second. She's going to actually be sharing with you the majority of the time today. She goes over the survey results. And then we also have Angelique and Alexis, who are a part of our Michigan-based team, and glad to have them here. On the next slide, I'll talk a little bit about First Children's Finance. So if you haven't had a chance to get connected with us, I know many of you have, but just a quick overview. So really here at First Children's Finance, our mission is to increase the supply and sustainability of excellent childcare. So that excellent childcare piece is very important to us, quality first and foremost, of course. And we know that the key to excellent childcare is sustainability and supply. And so we work on multiple levels. We work with state systems across the country to increase and improve policies that are supportive of childcare business. And we work at the community level to address the supply of childcare in communities. And then lastly, and probably most relevant to today's conversation, we work directly with childcare businesses, and we provide training, technical assistance, consultation on business and finance practices. So we offer a variety of supports, including access to capital. We are a CDFI and have a loan fund. And so there are a variety of different ways that childcare businesses can work with First Children's Finance to increase the sustainability of their childcare businesses. So we're really excited to do that. Before we dive in, no, that's great, Jessica.
Sorry.
Before we dive into the survey results, we wanted to place a little bit of context on the Detroit area that we're going to be speaking about today. So the rest of the conversation, I'm going to share a little bit of context on the childcare supply and demand in Detroit. And we're also going to share a little bit of information just for those who weren't able to join yesterday's webinar about the statewide data. So we'll talk about the statewide survey data very briefly, and then we'll dive into the responses that we got from Detroit childcare entrepreneurs. So first, the Detroit context. As we were thinking about what is the current status and state of business, childcare business in Detroit, we wanted to take a look at what is the supply. And so this is data that Jessica pulled, and it shows that across all types of care, we have about 478 total providers with a maximum capacity of just under 22,000. Now, this is data from February of 2025, so this is a bit of a snapshot in time. And at First Children's Finance, as we think about childcare supply, we think about, yes, certainly that maximum capacity, but we also think about what is the more realistic enrollment that is happening at any given time. And through our work, we have found that about 85% is the expected capacity of actual enrollment at any given time. So you can see that that brings the total expected capacity down to just over 18,000, just about 18,500 slots across all types of care. And then the other thing that we know from our work is that parents and families really need full day, full year. And that number requires us to pull out the slots that are part-time or part-year childcare. And so you'll see the expected capacity of full day, full year care is just about 14,000. We know that this may differ from the way that some others calculate childcare supply, but it's one of the reasons why we show this in these multiple looks to show that yes, there is a maximum capacity in Detroit of just under 22, but there's a more realistic capacity of full day, full year of 14,000, just over 14,000. And the reason why that's important comes across in the next slide, and that has to do with the demand for childcare. So pulling data from the most recent census data that we have, which is 2022, we show that about 62% of children under 5 have all parents or guardians in the workforce. And that number ends up being about 23,500 of the number of children that are under age 5 with all parents and guardians in the workforce. And then when you pull together the childcare demand with the childcare supply on the next slide, you can see that if you look at that maximum capacity, yes, there's a gap. The gap doesn't look huge, but when we look at that more realistic expected capacity, or when we look at, or even sort of more so when we look at the expected capacity of full day, full year, we see a larger number in terms of the gap between childcare slots available and the supply of, or I'm sorry, and the demand for full day, full year slots. So the reason why that we wanted to sort of start with that and tell that story is because we know that part of the childcare supply is childcare sustainability. And that's really what we're going to talk about today is what are the conditions under which programs are opening, programs are seeking to stay open or grow or expand their work. And we're going to be diving into some of the reasons and some of the experiences that our providers have. So with that, I'm going to turn it over to Jessica to talk more about our survey.
Thank you, Michael John. And again, we're going to go over some of the data that if you were present yesterday on our State of Childcare Survey webinar, we're going to just kind of go over some key points that we talked about yesterday on a statewide level, and then we're going to dive into some of the Detroit results. So to start, I want to talk a little bit about survey qualifiers. Survey responses were collected from licensed childcare business owners within the city of Detroit, which included, but was not limited to, privately owned businesses, nonprofit programs, GSRP and Head Start partnered programs. Licensed exempt providers were included in the survey distribution, though no feedback was received from this segment of the provider community. And then lastly, unlicensed providers were excluded from the survey. So it's licensed providers only that this data is coming from. So let's take a look at some of the statewide results. We did receive around a 9% response rate of total licensed providers throughout the state, including family childcare, group home, and childcare center-based providers. So we got about 709 providers that responded from across the state. As of June 21st, 2025, there were 7,828 licensed childcare providers reported across the state. And so again, that's about a 9% response rate. But again, like Michael John mentioned in the previous slide, the numbers fluctuate. The childcare data and childcare numbers are very fluid. So if you were to poll today, you may see a very different number. But as of June 21st, that was the total for the state. This slide represents the respondent composition by license type and region. So this is a percentage of providers that responded as well as the region that they're located in. This is reflective of the average total populations in each community and the total number of provider types that exist in the state overall. So we got a pretty decent across the board response. If you look at the tan pie chart for location, you can see that the bigger response rates come from the more highly populated regions like Southeast Michigan, Southwest, Mid-Michigan, and then the smaller percentages are coming from some of the smaller, less populated regions like the UP, Northeast Michigan, and Northwest. And then as for license type, we got around 20% responses from family childcare providers, 20% from group home providers, and 52% from childcare centers. And again, that's very reflective of what Michigan's licensed childcare industry is currently made up of. So across the state, it's a composition of 58% childcare centers, 24% family childcare providers, and 18% group home providers. So we were happy with how well it was distributed. So for the state data, I want to start with the question that we asked, how long has your childcare been in business? We asked this question because we were looking for the most vulnerable businesses. We want to see how many people have been in business for a strong amount of time, how many people have been in business for 5 years or less, and how many people are like close to retirement. So 20% of the licensed childcare providers in Michigan have been in operation for 5 years or less. And that's a combination of that 11% from 3 to 5 years and that 9% that is in the 2 years or less. So that 9% is actually still kind of in their startup process. This group represents businesses in their early, most vulnerable stages, still navigating startup challenges such as financial sustainability, enrollment, growth, and regulatory compliance. According to the United States Bureau of Labor and Statistics, only about 50% of small businesses survive beyond the 5-year mark. And those that do are statistically more likely to stabilize, grow, and sustain operations long term, especially with strong financial and operational systems in place. And then 20% of providers have been in operation for 31 years or more, indicating many are approaching retirement age. And this signals a potential wave of exits from the field, raising concerns about gaps in service availability unless transition or succession strategies are supported. So in total, 40% of Michigan's licensed providers fall into one of these two categories, either emerging businesses still finding their footing or veteran owners potentially preparing to leave the field. This highlights the importance of targeted supports to either help providers build a strong foundation to reach long-term sustainability or prepare seasoned providers for succession planning and knowledge transfer. When providers were asked when hiring in 2024, how easy or difficult was it to find qualified employees? Across the state, some of the key takeaways from this data point that we discovered was that Approximately 68% found it some level of difficult to find quality staffing in 2024. And that is a combination of the 33% that found it somewhat difficult and the 35% that found it very difficult. Only 12% of the total reported that no hiring was necessary at all. There were a lot of concerns in comments around staffing in general. The state's, the ability to pay fair wages as well as offer benefits. And there were several comments that expressed concern around the Michigan House Bill 4002, which was enacted in early 2025. For those of you who are unfamiliar, this bill amends the state's Earned Sick Time Act to provide a more flexible and balanced approach to paid sick leave for workers and employers. So some of the key provisions of House Bill 4002 that will greatly affect some small privately owned childcare businesses is that small businesses that is defined as 10 or fewer employees must provide up to 40 hours of paid sick leave per year. And then larger businesses, which is defined by having more than 10 employees, must provide up to 72 hours of paid sick time per year. Employers can also carry over unused sick time into the next year up to the maximum accrual limits of 40 or 72 hours, depending on the business size. So when we asked providers the average number of childcare slots left unfilled by age group due to the lack of teaching staff, we got an average of 1 infant slot per program, 1 toddler slot per program, 2 preschool slots per program, and 1 school age per program, and making an average of 5 total slots per program across the state of Michigan. Now, keep in mind, in Michigan, there are 3 types of childcare licenses. You have your family childcare, your group homes, and then your childcare centers. Group homes operate within a residential setting and can serve up to 12 children or 14 with an approved variance, and they do require additional staff to operate. So this data is representing programs that employ staff other than themselves to operate. So this is going to include your group homes and your childcare centers. So while group homes represent a smaller portion of the total percentages, if we were to just look at centers, the number of slots would go up to much higher averages. So these figures shown reflect averages across both license types combined. And then for the sake of perspective, and this is something that I'm going to share for the Detroit data as well, but for the sake of perspective, I calculated an illustrative example by applying the survey averages to the total number of licensed centers and group homes across the whole state. So if you apply this average of 5 slots per program to the entire state, and there are a total of 5,990 licensed programs as of June 2025, that are either group home or childcare center that require staff other than themselves to operate. You have 5,990 times 5 is 29,950 slots that could potentially remain vacant simply due to the lack of staffing across the state. And then we also asked, did you have a facility maintenance or repair issue arise that you chose to delay fixing? So across the state, a total of 51 respondents reported delaying a facility maintenance or repair issue. This is more than just a budgeting decision. It has real implications for health, safety, and licensing compliance. Delaying repairs can lead to non-compliance with licensing requirements, especially if the issue impacts the physical environment or creates safety hazards. And then barriers to improving program quality, since environmental conditions are a core component of Michigan's quality rating and improvement system. Limitations on growth, as programs with unresolved maintenance issues may struggle to qualify for facility upgrades, expansions, or higher star ratings. And then health and safety standards form the foundation of high quality care. When providers are forced to delay necessary repairs due to cost or staffing constraints, it can create a ripple effect impacting everything from childcare safety to staff morale, family perception, and ultimately the ability to level up a program's quality rating or licensing status. This data point reflects a broader systematic issue. Many childcare businesses are operating on such thin margins, making it difficult to invest in even essential infrastructure needs. We asked providers, how are you planning to adjust your tuition rates in 2025? And the response was interesting, with 38% of providers saying that they don't plan to raise tuition. This becomes an important topic to unpack with the childcare sector. Many providers report that they avoid raising tuition rates because they don't believe families they serve can afford even the current rates. And while this comes from a place of compassion and also self-preservation, it can create long-term challenges. So here is the hard part. When rates stay flat year after year while expenses keep climbing, the program ends up taking on more and more of the financial burden. Over time, that can really add up and lead to some tough consequences, like not being able to offer competitive wages to staff, putting off important maintenance or upgrades, operating on such thin margins that sustainability becomes uncertain. Even though the intention is to support families, not raising rates can truly unintentionally affect the very quality and stability that those families depend on. So with that, we're going to move into the Detroit specific results. So you're going to see some slides that mirror the slides that we just went through with the state results, but then you're going to also see some other slides with some different data points that we'll talk about. Before we go into it, I want to talk about the total number of survey responses. We did not get we were hoping to get more. We received a response rate of around 4% of total licensed providers operating in the city of Detroit, including family childcare, group home, and childcare center-based providers. I've been hearing from a lot of providers, and we're aware that they're surveyed out. A lot of them simply just don't have the time to complete the survey or even open an email from, an unfamiliar sender. There's just a lot of reasons why I think that the childcare providers in Detroit did not participate as much as we would have liked them to. But we did get some data, and that's good. So we're going to go with what we have. And again, I want to address that you might notice that these totals don't match the totals from the previous supply and demand gap slide. If you remember, the supply demand gap back in February that Michael John presented at the beginning, there were a total of 479 licensed programs in the city of Detroit. If you fast forward just 4 months to June, we're up by 23. So that's 23 new programs that have opened their doors in a pretty short amount of time. That's a great example of just how fluid and fast moving childcare data really is, but also a good thing for the city. And then this slide, again, shows respondent composition by license type in the city of Detroit. So the first pie chart on the right shows servant respondents by license type. So you can see we got 77% from childcare centers, 9% from family childcare, and then 18% from group home. And then across the total city of Detroit, it is made up of a composition of 65% childcare centers, 15% family childcare, and 20% group home. So let's go back to that question that we asked statewide providers. How long has your childcare been in business? This one was a little bit that 37% of licensed childcare providers in Michigan have been in operation for 5 years or less. So there's 23 that have been in operation for only 2 years or less. There's a lot of programs that are brand new in the city. There's a lot of programs that are going to need a lot of financial stability support in the city of Detroit to make sure that they become strong businesses. Again, this group represents those early, vulnerable startup programs that may face financial sustainability challenges, enrollment growth, and regulatory compliance challenges. And then we have 9 providers that have been in operation for 31 years or more. So there's a lot less in the city of Detroit that are nearing that retirement age. And it seems like an influx of brand new providers in the city. So that's just something to keep in mind when it comes to providing supports to the childcare industry. Does your childcare business employ staff other than yourself? So 95% of the providers that participated in the survey reported that they do employ staff other than themselves. Staffing has been reported to be one of the #1 issues related to the childcare industry across the entire state. So in the next few slides, we're going to focus on data collected specifically from the childcare business owners who employ staff other than themselves. We asked, when hiring in 2024, how easy or difficult was it to find qualified employees? So some key takeaways from the Detroit data was that approximately 71% of respondents found it some level of difficult to find quality staffing in 2024. And that, again, is going to be a combination of 43% that said somewhat difficult and 28% said very difficult. Only 6% of the total reported that no hiring was necessary at all. And again, we heard a lot of concerns around staffing, and that House Bill 4002 was brought up in a lot of the comments, concerns on financial impact when that enacts in their program. So here's that slide where we asked the average number of childcare slots left unfilled by age group due to the lack of teaching staff. And we got some different numbers for the city. We got around a total of 11 slots per program. So we had an average of around 6 preschool slots, 3 school age slots, and then 1 infant slot, 1 toddler slot per program, making a total average of 11 slots per program in the city of Detroit. And then again, for the sake of perspective, we calculated that with all of the group homes and childcare centers reported operating in the center of Detroit, which is 400 as of June. So that's 400 times 11 is 4,400 slots that could potentially remain vacant simply due to the lack of staffing. We asked providers, which workforce benefits did you offer during 2024? We split this data into 2 slides for better visibility in PowerPoint form. This is the first half of the responses, and note that this was a select all that apply option. So some key takeaways was that 50% did not increase hourly wages in 2024. So half of respondents did not increase their hourly wages. And only 20% of the participants either offered a wage increase or expanded from the last year. 10% discontinued offering the benefit of wage increases altogether. 81% did not offer health insurance. 76% did not contribute to a retirement plan for their employees. And then let's move on to the next slide, which is the second half of this data. 48% of participants did not offer paid time off in 2024. So again, almost half of the participants are not offering paid time off, and these programs will be impacted by that House Bill 4002. Let's move on to the next slide. We asked, if you increased wages or offered other incentives to attract or retain employees during 2024, will you be able to sustain those increased costs in the future? 29% said that they definitely would not be able to sustain increased costs, but a larger 43% said that they were unsure. So that is a total of 72% that definitely could not or were not sure if they could sustain increased costs due to increased wages. In the next series of slides, we're going to focus on data collected from all participants around maintaining a sustainable business. We asked providers during 2024, did you have a facility maintenance or, we already did that one. We asked providers, how easy or difficult was it to secure liability insurance coverage for your business? Just a little backstory on this. In 2023, as part of an effort to expand childcare across Michigan, the Office of Child Care Licensing allowed home-based providers to apply for a variance to increase their license capacity. This change permitted family home providers to care for up to 7 children instead of 6, and then group home providers to care for up to 14 children instead of 12. These variances not only created additional childcare slots in high-need areas, but also supported the financial sustainability of home-based providers by enabling them to generate more revenue. However, many providers who applied quickly discovered a major barrier. Their homeowner or liability insurance policies were either canceled or drastically increased in cost. Insurance companies began denying coverage or charging prohibitively high premiums for any household caring for more than 6 children. This challenge affected not only providers who have been granted a variance, but also family home providers exploring expansion into group home licensure. On this slide, you'll see that 38% of respondents reported that it was somewhat difficult and 5% said that it was very difficult, meaning 43% overall experienced some level of difficulty securing liability insurance. It's important to note that this question was asked to all providers, regardless of program type. However, with the 20% of total respondents identifying as family or group home providers, these findings closely align with what we've been hearing statewide. And when we did the survey last year, we got similar numbers. So this is an issue that has been ongoing for the past 2 years. Many liability and homeowners insurance carriers are hesitant to cover family child care homes caring for more than 6 children, making it challenging for providers to expand under variance allowances. Next, we asked, did you take any of the following actions to manage your business during 2024? This slide really illustrates the personal sacrifice that so many providers make in order to sustain their business. One thing that really stands out here is that 65% of respondents said there were times that they couldn't pay themselves a salary. And there's on the bottom there, you can see 10% responded as other. In the other comments, we saw some consistent themes. One provider mentioned, my husband had to give the business money out of his personal check to help me pay my staff. Another provider stated that I lowered my salary significantly in order to maintain my business. And then a few mentioned that they also work a second job. And that was a consistent theme that we saw across the entire state, is that there were plenty of providers that were working second jobs, which is very eye-opening because their job as a provider is generally more than 50 hours per week. We asked, how are you planning to adjust your tuition rates in 2025? And this is just the same slide that we showed you with the statewide data. 38% of providers said that they don't plan to raise tuition, and 9% reported that they actually plan to lower tuition in the city of Detroit. Again, this is something that will in the long run hurt them, especially with inflation and being able to give your staff raises. There are lots of reasons why it's very important to raise your tuition on an annual basis. And there are 9% of respondents that said that they plan to lower it in order to maintain their enrollment this year. Next, we asked in 2024, did any families leave your program for any of the following reasons, not including a child aging out? So as you can see on this slide, the top 3 reasons tied at 32% that families left programs this year were a parent or caregiver left the workforce, and unknown was another one, and then they moved their child into a GSRP, universal pre-K, or another free or low-cost preschool option. 14% reported other as a reason for families leaving, and some of the most common comments that we received in that category were families losing CDC scholarships and families experiencing financial strain and needing to cut out childcare. Participants were asked how part-time and school year only options impact their businesses. When we say part-time, this includes, but is not limited to, some of the free state subsidized programs, such as the Great Start Readiness Program, Head Start, Early Head Start, school year only programs that do not operate 5 days a week or full days, so anything under 8 hours a day. And here's what some of the Detroit providers had to say about how these free programs are affecting their business, these free part-time programs, I should say. One provider mentioned that it decreased my enrollment and income. Another provider stated that these programs impact my program significantly because any child that qualifies for GSRP leaves my program. Another provider stated it has made a serious impact to my daycare center. All 4 of my 4-year-olds have gone to free programs. I cannot support my program without preschoolers and may be forced to close my doors soon if something doesn't change. I have a GSRP program in my center and none of the children attend the summer, costing me significantly. And it is quite difficult to maintain the staff salaries. And then lastly, a provider stated, I cannot compete with the free programs. I will lose more and more families and eventually close if I don't buy into the program. I did not open my school to participate in those programs. My vision and mission don't align. That was a Detroit specific provider that made that quote. And we also included that in the statewide quotes because it was powerful. Another thing that I think is important to point out with some of these 3 and 4-year-olds being pulled from the private centers and the private group home and family childcare programs is that it's very difficult to even break even with infant toddler care because of the child to adult ratio. So any child under 2.5 requires a 1-to-4 ratio. So programs really struggle to even break even and mostly use their preschool, pre-K tuition to help offset the cost of running an infant and toddler program. So programs that are losing their 3 and 4-year-olds are really losing a substantial amount of income for their program. Next, we asked, were you able to access any of the following funding sources during 2024? The majority of childcare business owners that responded reported accessing the CACFP food program, 48% at 48%, and support from the CDC scholarship program at 43%. And then tied with CDC at 43% is I did not access any funding sources in 2024. 18% accessed IFF facility grants before they ran out of capital. Other than that, all of the other funding source activity was minute, including only 9% of GSRP community-based organization partnerships. We asked Detroit childcare providers to tell us how accessing funding sources had impacted their businesses in 2024. One provider stated that the IFF grant was helpful for getting a lot of my furniture and repairs done. However, I was spacing jobs out and ended up losing funding. I need additional funds to complete my classrooms. My playground didn't pass inspection and more. I pray another funding opportunity comes soon. Another provider stated I was able to maintain my rates, offer discounts, and give raises. Another provider stated it has allowed me to get caught up on all my business-related bills. Another provider stated I received the IFF grant and I was able to purchase much-needed new furniture. Another provider stated the grants helped with my initial startup process. And lastly, a provider stated that CDC payments allow me to sustain my business. Without them, parents would not be able to afford my rates and I would lose enrollment. Next, we asked providers, how has your household income been impacted by financial losses to your childcare business in the past year? You can see that 68% of providers stated that yes, their household income has been impacted. 23% stated no, and 9% chose not to answer. On the next slide, we've highlighted a few quotes from Michigan providers that speak directly to this issue. From Detroit providers. Detroit childcare providers on how their households have been impacted by financial losses to their businesses in the past year. One provider stated, I gave up my own salary to give out pay raises to my employees, hoping to turn things around and maintain staff. We're experiencing financial strain at home due to this change. Another provider stated, my husband has to give the business money from his paycheck every month in order for us to stay afloat. Another provider stated, if it wasn't for my spouse's income, I would not be able to remain in business. Another provider stated, we have made significant sacrifices in our personal life in order to keep our childcare business operating. Another provider stated, I need major car repairs that I've been unable to get fixed. Another provider stated, my business is draining mine and my husband's savings. And lastly, a provider stated that we are barely making ends meet. When asked, how long do you plan to operate your childcare business? While only a small percentage of providers say that they're planning to leave the field within the next 1 to 5 years, a much larger group at 42% said that they're not sure. So it is good. That's a good number compared to some of the statewide data. We got a much larger number across the state for programs that are thinking of leaving the field in the next 1 to 5 years. But the unsure amount, that illustrates that nearly half of the respondents are uncertain about how long they'll be able to keep their businesses going. And that uncertainty alone can be cause for concern. Next, we asked what types of support would be particularly beneficial for your childcare business. Again, this was a select all that apply. And we spread the data across 2 slides for the sake of visibility in this data point as well. So the first half, when we asked providers where they need the most support, marketing topped the list with 59%, saying that there's a major area of need. Right behind that was budgeting at 54%, and coming in close at third was support with recruiting, hiring, and employee retention practices at 45%. This is the second half of that data. Facility improvement grants came in at the very top of area of interest, with 77% of providers saying they want support in that area. Next was accessing public funding streams, reported by 54% of respondents. And then tied for third place on this slide at 41% each were loan training and professional development and tax support. Both areas where providers clearly see a need for guidance and resources. When we combine both sets of data from these last 2 slides, facility improvement grants came in at the very top. 77% of respondents said this was a major need. Next up was marketing at 59%, budgeting and accessing public funding streams tied at 54%. And then coming in next was recruiting, hiring, and employee retention, with 45% of providers identifying this as an area where they need more tools and strategies. And finally, tied at 41% was loan training and professional development and tax support. We asked Detroit childcare providers to recommend what they needed to keep their business financially viable. And here's what some of them said. One provider said more grants and funding for teachers. Another provider said we need funding to pay higher wages to retain highly qualified staff. Another provider stated increase in subsidy. Billing should be done by licensed capacity instead of attendance. Another provider stated funding and financing would greatly help my business thrive and survive in this current economy. Another provider stated that grants that support higher wages for employees and benefits. And then lastly, a provider stated, I need more qualified staff and funding to fairly pay them. So then that is the end of the data. I'm going to now transition off to Michael John. I'll give you the mic back.
I mean, you're going to give me the mic back to do something very simple, which is to say, like, what questions does this raise for you all? I know folks are on mute. I know there's a small group. Feel free to come off mute, drop something in the chat, whatever is most convenient for you. But we just wanted to create space for, like, what questions does this raise for you? Ideas, thoughts, reactions, like how might you use this in your work? Really open the floor. Was there anything surprising? Was there anything that confirms some thinking that you had? Anything that worries you?
Just gonna say really quick, I found the information extremely interesting. I hopped on the call kind of late, so my apologies. You may have already said this, but will this information and or data be sent like via email, or how can we get access to this PowerPoint?
Yeah.
My apologies. You probably said it in the beginning.
No. It's a great question. It's a good thing to reiterate. Yes, we're going to post, we'll post the results in the recording, and we'll send an email. We know that many folks registered for the webinar today, but weren't able to join. So this will be posted on our website and shared on our social media as well.
Okay.
We're
Thanks
also
so much.
happy. Actually, if you want to go to the next slide, or I'm sorry, Linnell, were you about to say something?
Nope, I just was saying thank you so much, because I was trying to write down notes as you and I were like, they're probably going to send out the PowerPoint, but I just found the percentages extremely interesting, and it wasn't like a shock factor of anything like that. It's just kind of the trend, I think. But one of the things I did find shocking is how much the providers are having to use their own income or their spouse's income, or other means of their own in order to survive, and how critical that's going to be in looking at the rates going forward, right? If people are going to be able to continue looking at that, looking at those percentages compared to, like, will people be able to continue? Will they be able to live their own, maintain their own household and their livelihoods and do this? That's so critical, do something that's so critical and needed. So that imbalance, it's yeah, just seeing the percentage and the imbalance is kind of not shocking, but yeah.
That's a
Yeah,
really valid point. If you get a chance to, or if you didn't make it to the statewide, if you do get a chance to watch that recording as well, you'll see that that is a common theme across the entire state of Michigan. It's overwhelming how many providers are using their own income to support their businesses, or their husband's income, or their own savings, taking out personal loans.
yeah, and I was just gonna reiterate that that's something that we see pretty regularly in our individual work with childcare business owners. And so to see it confirmed that it's not just anecdotally something that we're seeing with individual providers, but it's something that we're seeing that's fairly widespread in terms of people not taking a salary, or in terms of subsidizing their childcare business with other income or their personal. A lot of times we see a lack of, or a commingling of business income and personal income that can sometimes even disguise or mask some of these issues that are very real.
Yeah.
Is there anything that popped up, anything else that popped up for folks, or any ways that, and Linnell, the other thing that I wanted to say is, like, we're also happy to share more that, like, this is the highlights of the data. If there's specific data that you're interested in, or that anybody on the call is interested in, or you'd like to work with us further on digging into the details, we're happy to partner with you, share the data that we've been able to collect, and make it more meaningful for all. Is there
Thank
any,
you.
was there anything else that popped out? All right. Well, I'm not gonna. I don't want to cut the conversation off too fast, but I did my best as a facilitator to let silence sit for a minute. We're gonna go to the next slide and just mention a couple of ways that that we would love to partner with folks. First and foremost, with childcare businesses, as I mentioned at the beginning of the call, we offer a large roster of training. We offer individualized consultation. So when folks are facing some of these challenges and want individual support from Alexis or Angelique or Jessica, we can actually provide individualized consultation on the challenges and opportunities, whether it's expanding or addressing a crisis. We can do some of that individual consultation and financial analysis on your individual childcare business, or the individual childcare businesses. We also offer access to capital through loans. So there's a variety of supports that, we hope that you'll continue to get the word out to childcare businesses that could use our support. And then in terms of partners and communities, the referrals are the big ones. We hope that you all will pass on these resources, pass on our name, pass on our contact information. And we also hope that you will leverage the data from this survey for your own work. And like I said, we continue to be open to sharing more, talking more about the data. And then lastly, for communities that are looking for support in building in developing strategies for increasing the supply of childcare in their communities, we do offer consulting to communities. And then lastly, we're always looking for funds to support our work, of course, whether that be public funding or philanthropic support. There's an opportunity for funders to support our work statewide, or in your community. And our website is firstchildrensfinance.org/Michigan, and info@firstchildrensfinance.org is our general email box. But Jessica, if you want to go to the next slide, we'll just put up the individual contact information for all of us. You can reach me at Michael John M, Jessica A for Jessica, and Angelique and Alexis you see there as well. So With that, we've come to the end of our webinar. We're really grateful for you taking the time, for all of you who joined us live, and for all of you who are watching this on the recording. We hope that you'll reach out to us and continue to look forward to partnering with all of you in the future. So thank you. We will stick around. Jessica, I think you can end the recording. Feel free, we'll stick around if there's